I think it's all about track record. When you don't have a lot of track record, you have to find something. When I found my first investor, I already had some track record in getting real estate investments. And at the time I had a single family home and a duplex. It was not a lot, but it was some track record. So that's how I got my first investors in mobile home parks. And with that track record, it kind of grew to what it is today. And then just, referrals from people because, they're satisfied with our performance. They told other people about it and really just track record.
You're listening to the Rich State of Mind Show, the podcast made to make you the total package in the entrepreneurial world and give you what we call a rich state of mind. If you are here looking to learn about real estate investing, marketing, elevating your business, and developing your mindset to get to the next level, then you are at the right place. Stay tuned and be sure to join our community on richstateofmind.com. Now here's your host, Anthony Ritchie.
Hey everybody, welcome back to another episode of Rich State of Mind, where I'm talking to Charlotte Dunford. Charlotte is the managing partner of John Creeks Capital, an investment management company that focuses on mobile home park investments with a total investor subscription amount of over 4.2 million. So pretty substantial. Numbers wise, they currently have about 20 park investments, and Charlotte herself has also created over 500K in asset value in the past 12 months. And Charlotte really comes from a humble beginning. You'll hear a part of her story and where she's come from and how she's been able to get to where she's at now. So that part was very beautiful to me. And also you'll hear from the real estate side and how she's been able to acquire these properties and why she's chose mobile home parks. So as always, thank you for listening and please enjoy. Hey, Charlotte, thanks for taking the time this morning. It's Saturday morning. I don't know how the weather is for you down there, but it's raining up here. If you could please just tell us a little bit about yourself and what you do.
Right. My name is Charlotte Dunford. I am the managing partner at Johns Creek Capital, which is a small mobile home park syndication firm that focuses on small to medium level mobile home parks. Currently, we have 27 mobile home parks under management and over $4.8 million in investor subscription. We're closing on our 27th park in a week.
Awesome. That's pretty awesome, especially in a short amount of time because you said you guys started in 2020.
Correct.
Yeah. So I mean, I think that's great. Let's talk. I guess go back a little bit. From my understanding, you're first generation American.
Yes, correct. Yeah.
So explain that part. Moving here as first gen with minimum goods and starting your life pretty independently. How was that to get all the way to this point now?
Right. So I moved here to the United States when I was 16 years old, and my parents didn't come with me. So I just pretty much went to high school, and graduated high school and went to college, one of the top engineering schools here in the South, and graduated college, took a job, and pretty much started real estate investments and started Johns Creek Capital, and here I am.
Oh, I mean, if you don't mind me, how old are you?
I'm 28.
Yeah, you're young, very young, doing something like this. What got you into real estate? What event happened in your life that exposed you to say, all right, I think this is something I want to do?
Right. So, I mean, I've always been interested in real estate. Where I came from in China, people are not really where people are not allowed to legally own real estate. You can only lease it from the government, so everything's illegally owned. So, to me, it's always sparked an interest in me that I wanted to own real estate in the United States where the opportunity is allowed. So, ever since graduating college, I started qualifying deals, buying deals with my salary to buy real estate, and up to a point where my salary was not enough to finance larger deals or the amount of deals I wanted. So that's when I decided to take the jump to start my own company.
And so one of the questions I think people always ask, because I'm pretty sure there's some people when they've listened to these syndication episodes, they're like, okay, cool, capital group, they got people to raise money and then they buy a property. I think a lot of people can figure out the underwriting portion, maybe even finding the deals. But how do you, especially, let's say back in 2020, and go back to that time frame, how do you get your first investor? What does that take?
Yeah, so that's a great question. So I think it's all about track record. And when you don't have a lot of track record, you have to find something that when I found my first investor, I already had some track record in getting real estate investments. And at the time I had a single family home and a duplex. It was not a lot, but it was, some track record. So that's how I got my first investors in mobile home parks. And with that track record, it kind of grew to what it is today. And then just, referrals from people because, they're satisfied with our performance. They told other people about it and really just track record.
And how do you mark yourself? Are you like on LinkedIn, or is there some
Yeah,
type
I'm
of
on LinkedIn and other kind of social networks, but mostly on LinkedIn and our website, obviously. So
awesome? So let's go over your first deal. What was the numbers on that deal? How big was the park, and how much did everybody, or what was the minimum that needed to invest? Because with mobile home parks, I know, well, with multifamily syndications, usually I'll come across like minimum is 25K and then they'll take up to 100. Is the dynamics the same way with mobile home parks, or is it cheaper, low, is it a lower barrier of entry? Just curious.
no, I think it's pretty similar, except our maximum goes up to, I mean, we have investors, in total invested in over $2.7 million single-handedly. And lowest, it goes down to 10,000, but that's just an exception. Most of them have to be 25,000 and above. So that's kind of the range. But per deal, I would say it's anywhere from 25,000 or 10,000, depending on the deal, but that's pretty rare, to all the way up to, I think, 400,000,
Mhm.
so that it depends on the deal, it gets bigger. So maybe our first deal, I mean, the first deal was really not a good example of, kind of how our deal structure was, because that was, we're still trying to figure out the deal structure. So, but what I can tell you is the deal that we just recently sold. We bought the deal in 2020. So
Mhm.
that's actually one of our first deals. We bought the deal in 2020. We bought it for 325,000, and we sold it for 492 500, sorry, thousand, sorry, 492,000 ish. So that's what we sold it for. The IRR on that deal is approximately 18% in under 2 years hold. And the annualized return for investors only, not counting the money that we made as a sponsor, was over 20%.
And what's IRR?
The internal rate of return. So that the internal rate of return is a parameter that takes into account of the time value of money. So the longer you hold something, the lower your IRR is, because the money value always goes down with time.
Did
The
you
equity multiple
anticipate?
is 1.37. Yeah.
Okay, gotcha. Sorry about that. Did you guys anticipate to keep it for 2 years, or was the original plan 5?
No, the original plan was 3 years, but usually, we try to prepare to exit early, because you just never know how long the exit is going to take. So we don't want to get investors' money stuck in the
Hmm.
deal.
And so for your exit strategies are only when you sell, or do you do seller finance? I mean, not seller finance, cash out refi.
We could just cash out refi, but in that scenario, so because when you do cash out refi, it's really not an exit. So you
Yeah.
you still hold the deal, but you can make some money out of it. But it really depends.
Hmm.
There isn't really much point to do cash out refi when the interest rates are so high, or when it's not attractive to do so. So
Gotcha.
there's so many factors to consider. Yeah.
Gotcha. Okay, yeah, that makes a lot of sense. And I guess, as time progresses, you have to kind of study what the market's doing in order to make that type of decision on what your exit strategy is going to be to pay everybody back.
Mhm.
Does John Creek Capital or John's Creek Capital, do y'all pay monthly, quarterly back to your
We do.
investors?
We pay monthly distributions.
Oh, wow, that's awesome.
Hmm.
I know a lot that pay quarterly. I'm pretty sure people
Yeah.
really like that monthly one.
Mhm. Yes, definitely some consistent cash flow.
Let's see. So what are you, clearly we've been talking about mobile home parks, but we haven't talked about why. what got you to do mobile home parks? What are some benefits you realize in it?
Right. So I am a firm believer in blue ocean strategy, meaning that finding the opportunity in a market that is not extremely heated or, highly sought after at the time, because mobile home park has always been a long ignored sector where everybody's chasing after multifamily, everybody chasing after something that's extremely heated. But for mobile home parks, it's really not as heated as the other ones. So that gives me a lot of opportunities to buy at a really attractive price. And the asset class itself, the demand is ever growing. There is a kind of affordable housing crisis that our country is facing right now. And the supply is limited, which means that due to zoning regulations, there actually is extremely difficult to build new mobile home parks and extremely expensive. So they're not really being built. Even if they are being built, there's no way that they can catch on with the growing speed of the demand. And the fact that it is inflation and recession resistant makes it even more attractive, meaning that in a recession, people actually tend to look for a less expensive housing option.
And mobile homes, I guess I'm looking at the information on your website. Range like you could have $280 to $600 a month, where a normal apartment would be $1,100.
Right. So mobile home park lot rents are incredibly low to start with, usually compared with another housing option or housing product in the market. The gap is pretty big, which means the value for money for mobile home parks is more. So people tend to compare those housing options and find the best value.
Do you believe that, what did you call it, the bluefish method?
Blue ocean strategy?
Blue ocean strategy. Yeah. Do you think that with, rents increasing pretty high right now and the cost of living going up pretty high, that people will start to, more people will start to shift over to mobile home parks?
Right. I think they will. But the blue ocean strategy mostly talks about in a marketplace where investors like me and our investors are looking for the same thing, but a lot of them are not looking for mobile home parks. A lot of them are not looking for small to medium level mobile home parks, and especially in our niche. But they are getting more attention, but I think it's still a small.
Stability and rent. So when I think of stability, are we saying it does the rent of a mobile home is not completely affected when the rents out in town are going up?
It is affected, but stability, you can look at it different ways, right? The stability means mobile home parks is a parking lot business. It's a land business. So because it's a land business, people own their home. It's a parking lot. So stability comes from that they can't really move their homes out. Even if they do, it's extremely expensive. Right. And the rent is really separated from the stability part of it. The rent, your question is, are the rents going up because the other prices are going up? Yeah, because when the rents are low to start with, and as long as there's a gap between the lot rent and what they're paying in other housing options, this option is still attractive.
Okay. And then because I do see that the turnover rate is lower, significantly lower than somebody that rents, because they treat it like it's their home.
They can be lower when a park is majority tenant-owned homes, meaning the tenants own their homes. The turnover rate can be lower because, like I said, they own their homes, and they, if they have pride of ownership, which is something that we try to boost in our communities, then they do tend to be lower. Yes.
Is that considered one of the things you consider when you're trying to acquire a mobile home park? How many people are renters and how many people are homeowners?
Absolutely. That's one of the most important parameters.
And why is that?
Well, it's because they own the homes, and this business is not a rental business. It is a parking lot business. It's a land business. So we don't want to turn mobile home parks into something else. It's not what we're buying. We're buying mobile home park. It's a land business.
You're buying the land. You're not buying. You're not trying to own the actual units.
Right. And the tenant-owned homes, they have less repairs and maintenance costs, meaning that they own the home, so they're in charge of, tenants are responsible for the repairs and maintenance inside the home, and we are in charge of the park infrastructure. So It's supposed to be run that way. The lower repairs and maintenance and pride of ownership, lower turnover, and that's how it's supposed to be run. So we absolutely prefer more tenant-owned homes.
If you had to, what would be a good ratio, like 80-20, 80% are owned? And then if you, out of 10 units, if 8 of them were owned and 2 of them you just had to have on your books, would that be okay? Like, would you still take that deal?
Well, it depends on what the park-owned homes conditions are, how old they are, their conditions when they're built, and do they have issues, right? Because that's the biggest killer is they have repairs and maintenance like you wouldn't believe.
Well, because usually with mobile home parks, when it comes to those homes, let's just say they are pretty bad and you can't repair them. There's no refurbishing, renovating them. You have to get rid of them, correct?
Yeah, most of them can be refurbished, but if there are cases where you cannot refurbish them, most of the time you can refurbish them.
Okay.
But you may need to spend a lot of money on them. Yeah.
As much as it probably costs to get a new one.
Yeah. So which means that it's a better idea to sell it to a tenant and let them fix it up, or just fix it up yourself, or just leave it alone. That causes another issue where, the health department may go after you and say that there's something wrong with your park and it's unsafe because you have this abandoned building. And that's just another can of worms. So I'll stay away from that.
What are some expenses that, if, I'm an LP, a limited partner, and I say, hey, I want to invest with you guys, but what are some of the expenses that you will incur on a monthly basis that would affect, obviously, bottom line?
Well, just like any real estate, if you're an LP, you'll get the financial reports from us every month. So there would be the cash flow statement and P&L. Just like any other real estate expenses, right? So with mobile home parks, it's nothing really different. So repairs and maintenance, contract work, contract services, and taxes, mobile home taxes if you have any park-owned homes, and insurance, and payroll, admin, management fees, and all the other good stuff. So yeah, just pretty general as all the other real estate expenses. Yeah.
Do you guys, when y'all buy the parks, do you guys manage the plumbing portion, or is that the tenant that owns the house? They manage
plumbing. Yeah, any plumbing inside a tenant's home is up to the tenant. Any plumbing outside of tenant homes that's up to us, because obviously that belongs to the park. So it really depends on who owns the park, who owns what portion.
Yeah, because I was the plumbing part that comes out of the ground, that part is you guys.
Yes, correct.
Okay. What's this life shelf on that? Is that usually something that you have a problem with? You're like, hey, that'll last us about 30 years. We're good when it comes to that.
Yeah, when it comes to what?
Just the in-ground plumbing.
Right. So, it could have issues, just like any public, sewer and water system. It could have issues, but usually our whole time is 2 to 3 years, sometimes to 5. So we don't really have to worry about, you never really need to replace the entire infrastructure. It's never really happened. Usually you can fix it and, repair to the point it's working. You don't need to replace the whole thing.
The cool thing is you get out of there in a decent time, where that might not be somebody's issue until 10 different acquisitions later.
Yeah. And usually it should not break down entirely.
Yeah.
Usually it doesn't.
Is there particular areas that y'all look for? Because you're in Georgia. Are you only doing Georgia? Are you doing all over the country?
Yeah. So we actually only have one park in Georgia, and we have pretty heavy presence in the Midwest and the Southeast. So a lot of park in Iowa, some in Illinois, some in South Carolina, North Carolina, Kentucky, Tennessee, and then we do have some that are further away in Montana, one in Arizona, and also one in Wisconsin, another one in Maine. So they're really all over the place, but we have a heavier presence in the Midwest and the Southeast.
And how do you find these deals? Are these referrals, or are you driving around, or is there maybe a website you're going on?
So since we started, we developed a system to get those deals. So everything is systematic. It cannot be something that you just kind of like, oh, I found this deal, I'm going out to find this. So it's, we build relationships with brokers and sellers and buyers and people who are in the industry. So they really send the deals to us. And pretty much the deals are coming to us, and we pretty much have underwritten thousands of deals at this point.
And then how long do you give LPs to contribute towards a deal? Is it like a 3-4 month process where you're collecting funds?
So it's deal by deal basis. So every deal has an LLC that's built around the deal. So it's not really a fund. So nothing is really, it's not like a fund that we just decide to invest in whatever. So the investors will be able to review the details related to this deal. And usually it's on a first come, first serve basis. Once it's closed, it's closed. It's fully subscribed. So usually
Gotcha.
it gets subscribed within 2 weeks.
Oh, that's awesome.
Yeah.
How do you set up the LLCs around these parks? And why is each park an LLC?
Well, that because it keeps the liability separate. And because that gives investors, some sort of, that gives them the protection, it's not related to all the other parks. It's not really, they will be able to see what exactly they're investing into this deal rather than a fund, which is also an LLC. It could be an LLC. So you're just investing in a bunch of deals that investors have no say in. So just a different comfort level.
No, and I appreciate that you guys do that. I think that's transparency. I think is key, especially when people are giving thousands and or $100,000 worth of their money to something that obviously they want to be profitable. So it seems like you guys have great communication and are pretty realistic with your numbers and what you do as well. I think you found a great niche as well. So I really do hope it continues. You mentioned earlier that it is not as attractive to certain people. Why is that? Is that because of the stigma of trailer park trash or something? Like, why is it?
Well, things are not attractive to people, anybody, for any reason, right? So some people like Apple, some people don't like Apple, some people like this and not that. So,
Yeah.
Things can be attractive or not attractive to people, and some people like, some people don't. So I really don't know. I cannot pin on a reason why. And I do know why, and it's not something that we choose to focus on, really. I mean, it's not really
okay.
I mean, it's not really something, some people are not attracted to mobile home parks. Some people are not attracted to self-storage. Some people are not attracted to single family homes. Some people are not attracted to real estate in general. So people have their reasons based on their life experiences. And, that's just what happens. It's okay.
Gotcha. That makes sense. All right. So you guys been doing this for 2 years. Already got, you said 14 parks?
Over 2 years. I mean,
yeah.
Almost, yeah. Yeah.
And so, almost 2 years, 14 parks.
No, 27 parks.
27 parks. Jeez, that's crazy. What is your future? What do you see yourself doing with Johns Creek Capital in the next few years?
Yeah, so towards the end of 2020, we're looking to build a fund that would allow investors to diversify more across the board. As the comfort level goes up, as we get more and more referrals, that will be the goal, and really ramp up our acquisition efforts because prices are starting to lower as the rates are going up. And we're still focusing on this strategy, focusing on what's been working, and continue on.
From a management perspective, and I guess this will kind of go towards somebody that's maybe interested in starting their own capital group. How do you manage these 27 parks? How is this possible? Who's in what position or responsibilities to help you successfully manage all of these?
Right. So really, it takes a really top-notch team you need team members to be really good at what they're doing. So you need a really good property manager inside your team. That for us, because we have smaller parks and around the country, and we don't really trust third-party property managers to manage all of our stuff. So we'll manage it in-house. Property management, operational side, you need it, operational manager, and you need someone who's extremely good at finance. And so you need a great team, finance, accounting, CPAs to prepare your K1s, do the tax depreciation schedules, value add coordinator, attorney. So you really need an all-star team to be good at it. And then you, as the founder, you have to have a vision and a mission, and you have to understand the market. You have to have some sort of engineering background, or it doesn't need to be engineering background, some sort of, you have to have the mindset that you need to solve the problems, and you know how to solve a problem. So that, I think those are critical.
Is your entire team in Georgia, or you have y'all work remotely together? Okay.
The team, most of team members are in Georgia, and some of them are in different states.
Gotcha. And so I want to ask you a question that I ask everybody, and it's what is your rich state of mind? What's your big why as to you're doing something like this on such a large scale? And so you're honed in on a specific niche, clearly. And so, what's your big why?
Well, the big why is, like a lot of people, I think for me, the opportunity to own property in the United States is a huge plus and huge opportunity. And for me, I get to appreciate it in a different way than a lot of people who are born here and given the opportunity. So I think for me, it's just important to make it out of whatever that I have the most, because it's important to utilize my resources and to achieve what I always wanted.
I think it's first of all, I learned something new. I did not know that you're not allowed to own real estate in China, and you had to lease it from the government. And so it helps me understand the appreciation you have coming over here, that America is literally for sale.
Yeah.
And you are definitely taking that opportunity and grabbing it by the horns and pretty much running away with it. Like I said, at a young age, that people that are twice your age are not even doing this yet, and they've been in real estate. And so I think it's pretty cool that you've grasped onto this concept pretty well. You found a niche that will work. You came from it from a solving a problem perspective, which I think if you do that, you'll always be ahead of the curve. And so that's why I had asked you too, what do you see yourself doing in years from now? Because I can imagine you're already kind of thinking about the future and what you can, because you have to have that vision, right? That's where that team comes in, so that you can focus on the vision part. So thank you for sharing that. Thank you for being very transparent. I definitely want to make sure we share all your information. So if people want to invest with you, they can. And then also you gave some insight into what it takes to run a park as well. So yeah, thank you so much, Charlotte.
Thank you so much for having me.
Thank you for sticking with us from the start of the episode. Please share our show with friends and family, visit our YouTube channel, and view more of our content on richstateofmind.com. See you next week on the Rich State of Mind Show.